Welcome to the Real Advisor Podcast. TRAP, TRAP. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the TRAP team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of TRAP.
Yes, indeed, dear Trappists. Welcome back to what many people are calling episode 51 of the Real Advisor Podcast, TRAP, TRAP. My name is Lick Ninken. Joining me as ever in the digital studio of doom are the three other horsemen of the apocalypse. Alan, the storyteller Smith, Andy, Ultra Heart, and Carl, the voice, de la voce Widget. Gentlemen, we have a show packed full of absolutely nothing. So let's start unpacking it straight away with some high-energy review read or reads. Mr. Hart, the floor is yours.
Thank you, boss. Okay, my first review is from Jack Farmer 98, entitled Wealth of Knowledge, 5 stars. I'm 25 years old, and I've been advising for a year and a half now with a great company that does full-fat financial planning, in Nick's words. I love the podcast, not just because of the banter between you all, but because of the nuggets of wisdom you can take away. It helps me a lot because it confirms what I'm doing, that I'm doing the right things. This is the best financial planning, personal finance podcast out there that you can listen to. And if you want to improve your clients' lives and your own too, thanks, guys. Next up, there's 2 today, Nick, just to stress you out. This is from Love Adopt. Sounds very odd. Refreshing advisor content, 5 stars. As an advisor in Singapore, interesting. The podcast provides extremely refreshing content compared to the normal backwards-looking industry subject matters. I've passed it on to other advisors as an example of a better way to give financial planning advice @expat planner. Back to you.
Great stuff. Thanks, Trappers, for the reviews. We do love them. Please do keep them coming in. Please do make sure they are a 6 out of 5 star.
It's great that they have these international listeners from all sorts of places. You know, you go on Chartable, you can see all these. We pop up in all the weirdest and wonderful places. Remember, we were number 1 in Mauritius, the podcast charts.
Who can forget?
I've noticed recently, again, random Namibia. What's that all about? Is that Lunch Club Dirk going on his holidays or something?
One download.
That's the first thing you do when you wake up in the morning, Alan. You check Chartable from your bed.
Yeah, something like that. Okay.
What's next? Good stuff. We have global reach. Let's leave it at that. Okay, let's put a timestamp on episode 50. I'm quite happy with my 1 today. They're actually quite organised. Let's crack on and put a timestamp on episode 51 with some topical tidbits. It's supposed to be the summer, right? The dog days of summer, and not much going on, but there's loads going on in this thing of ours and outside of this thing of ours. Not all of it great. But we'll try and make it great for you, dear Trappist, and bring some levity into your life. This is forced levity, so bear with me. I'm doing it through gritted teeth. Okay, first topical tidbit. Something of yours is shrinking, Alan.
Yeah, I don't think it's just mine. There was a lot of press, a lot of reports in the trade press of the last couple of weeks around the fact that, as we've spoken in the last episode, we've just gone through the first anniversary of this piece of legislation called Consumer Duty. It's caused a lot of people in our sector to sort of sharpen their acts up, focus on delivering services to clients, up their compliance and regulatory game, all of which are, sound business things, and all of which come at a cost. And there was several reports about firms, and I didn't really like the word, it seems inhumane, but talking about culling their client bank. There's a thing in Citywire, New Model Advisor, there's a thing in Money Marketing. And yes, firms were saying, look, we've got rid of 20% of our client bank in the last 12 months, which, I found quite hard hitting, I suppose, quite brutal. Makes me think, what were you doing before that allowed you to deal with these clients, but now you can't?
Not much,
very
yeah.
And I think I feel a bit. I mean, look, it's a big subject. You can't necessarily deal with everyone, and there's a question of, does everyone out there in the universe actually need advice? We tend to, what's your phrase, Andy? We tend to deal with more complex problems then
we answer expensive financial questions.
Yeah, not everyone's got super expensive financial questions. There are a lot of people, I guess, out there in the general public who probably maybe they've got auto enrollment, they've got relatively straightforward requirements. You can have, life assurance and protection is still available on a commission type model. Anyway, I just thought, we'd raise this. If the industry is changing, something that there was it did refer to a survey that Lancat did, which said a couple of years ago, 11% of the UK population paid for financial advice. That number has now shrunk to 9% of the UK population. So less people. Is this kind of unintended consequences? Talk about the advice gap. Less people are actually paying for and receiving advice around their personal finances, and a lot of the blame has been put at the door of Consumer Duty and the sort of compounded effects of additional requirements over the years. Any thoughts?
I think you covered the bulk of it, but yeah, it is a long-term trend in terms of the advice gap, and all the different legislations that come out at different times sort of add to this. There also in the article it mentions that the minimum asset level now is increased by 12% from last year. The minimum asset level they're saying is 214,000 from the study that they conducted.
That's the minimum asset level that the average advisor will take on. One of the firms in the article had a 200,000 minimum. They've now moved it to 500,000.
I think that's
quite a material. Not. Hence, a lot of money, do you think?
Hence regulated financial advice is a luxury item. There's obviously cheap online DIY platforms. That's where all these people that don't get advice will end up, which is not a bad thing, let's say. But when they build up the assets to a certain level, then they might need to seek help from someone like ourselves. But yeah, it's a long-term trend.
Okay, let's crack on because we've got loads of stuff. And the last episode was 1 3/4 hours. And I think we're still recovering from that. Okay, Ultra. Yes, go on. Surprise us with another tale of these volatility protecting funds not doing what they're supposed to do.
Yeah, I think, it says what it says on the tin, as it were. Funds offering protection from volatility failed to deliver in the sell-off. Whenever there's protection and guarantees, it's red flags from me. And again, these funds have been, created by marketing departments to sell to investing illiterates. They fly off the shelf. And at the time, they're meant to do what they were sold to do. They don't. So there's a link to the ft.com article. Any comments?
Yeah, these are covered. What do they call it? Something complicated. Covered call
crash.
Oh God! Covered call. Covered billions flow into. I hadn't seen the article. I read it when you sent the link around. Billions flow into covered call ETFs. Again, I mean, this will never stop.
No,
this will always. So what this is a kind of mechanistic financial structuring to deal with what is fundamentally a human behavior problem, right? That's what it is. And
volatility is a feature, not a bug. Where they're obviously trying to remove
so
it.
We want to dampen volatility, so we create these complex instruments, and it does. I can't see the notes, but it does say, well, it's billions. Create an ETF that employs these strategies, which are designed to dampen down volatility. And guess what? Just when you needed it, it failed. So it's quite a good article, actually, in the FT, because it shows they underperformed the S&P, as an example, whilst the markets were racing away. And they fell pretty much just as far and fast as the markets in the recent short-term correction further. So they've done exactly the opposite. Well, they've added no value whatsoever, but they are aesthetically attractive to
the guardrails didn't work.
Guardrails didn't work. And how often does this happen?
Every
single time. All the time.
Yeah.
Absolute return funds. It's just garbage.
It does. But as I say, it's to deal with the behavioral problem. And this is the biggest thing about it all, is that people want, I don't know, mental security, safety, want to relax, want to do it. And there's other ways of achieving it, because there's little or no past track record of these things ever really working consistently, but people still pile into them.
Yep, agreed. Okay, we've done that one. Wodge, FPSB, what is it? Tell us about it.
So the Financial Planning Standards Board in Ireland, I've mentioned them before. They gathered a bunch of firm principals earlier on this year, or was it? Yeah, I think it was earlier on this year. Anyway, led by Emer Kirk. And they've come out with their 5-year strategic plan. and they're doing some surveys and that kind of stuff. Anyway, the whole premise of this is that they're trying to raise awareness of real financial planning. So can only be a good thing. Slowly, but surely, we are seeing it become, more mainstream here in Ireland. So look, rambling on here, and Emer Kirk's work in the FPSB and some of the other people in the Irish Ideas Exchange, it's working. We have a job to do, right? But long term, we'll get there.
What other factors do you think are at play here, Carl? Do you think it's younger clients seeking that? Do you think it's the tech influence? Do you think it's what else is? Because it can't just be what the FSB is doing, because they're like screaming into an empty room, if that makes sense.
No, yeah, but I'm not sure they are, right? Because so obviously they're in charge of delivering the CFP modules and qualifications, and it seems to be, that everybody, the QFA is the most basic qualification that you can get to operate in our business. And a lot of the younger folk are doing the CFP, and the CFP is all around what does real financial planning do. So a lot of the younger folk are, in banks or firms whereby it's product selling and blah, 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 and they're seeing the light, and I think they're probably pushing it as well. But there are lots of clients who kind of are beginning to get what financial planning is. And I liked your thing earlier on, Andy, that not everybody probably does need real financial planning, but you get to a certain level, and by God, if you don't have it, you're going to be in trouble at some stage, because I'll talk about the upcoming budget and some changes. I'd hate to be someone doing it DIY. You'll end up with big tax bills if you're trying to do it.
There's so many financial landmines that people don't see.
But often this can be a self-perpetuating thing if you actually deliver this stuff. And obviously, as we know, CFP is a global license. Originally come out of the US, but it's now global as CFPs all over the world. And as I understand it, this organization you just talked about, they're the upholders of the standards.
Correct.
CFP, right? So it's a global thing. And obviously, other than that, on a country by country basis, there'll be a lot of differences. But this is a global standard. And as we've all experienced over the years, once you learn this stuff, now you don't necessarily need to have the CFP license to do it, that's for sure. But it is one way of demonstrating that you do know what you're talking about, particularly someone who's early on in their career. But once you experience the client's reaction, you don't want to never not do it, because the difference between sitting with a couple, running through a detailed financial plan that you've created yourself or co-created with them, and if you've got the framework through the CFP to learn to do it, the feedback you get 99.9% of the time is just so good, you never don't want to do it. So I think you may be going through a tipping point there in Ireland, just to say, and those people will then speak to their other mates, and as you see, the Irish Ideas Exchange and so on, it becomes a self-fulfilling thing.
Yeah, there are 6 modules in the CFP, and the final one, you have to do it last, so you can do the others in whatever order you want, is financial planning, right? So everybody in Metis who's done the CFP have all went, absolute, easy peasy, it's what we do all day, every day. But I do know some of the people from, say, the banks or whatever who aren't doing finance. This is like looking at Latin and trying to decipher it. It's like, holy shit, what is this all about? But, and here's the big thing, when they go through it, they go, but sure, why wouldn't everyone do this? Everyone needs this. And then they go, oh, there are actually firms who do this, and then they decide on what financial products. So people are seeing the light. I'm very optimistic as to the future here. It's going to be a slow burn for sure, but I know that all of the firms that I'm talking to who are doing financial planning are absolutely knocking it out at the park at the moment. And I do also know that none of the people who are doing financial planning, we will be touching on this later on, are getting any phone calls from their clients about a perceived market decline. So they're doing their jobs properly. Anyway, spoken too much about it, but I'd like to say well done, Emer Kirk and her team at the FPSB.
Good. Very encouraging. Okay, so this is the time of year when I get my regulatory invoice from the FCA, with the FSCS levy included in that. And Ultra, Storyteller, I don't know about you when you get yours, but seems to be the continuing fall in regulatory fees is ongoing. I was just looking at the figures. My my levy fee now is 42% down on what it was 4 years ago, and obviously turnover's gone up between now and then. So that's just pretty much unabated good news. So long may that continue. You guys experienced your levy invoices recently?
Yeah, we have similar, maybe not quite as much as that declined for us, but yeah, significant material differences. Now, part of that is because it peaked at a crazy rate when the FSCS, and there was all sorts of scandals that had to be covered for. So there was a time a few years, maybe 3 years ago.
British Steel, wasn't it? British Steel.
Yeah,
and
that's
DB
probably
Tran,
it. Yeah,
Lighthouse bonds.
London and Capital, London, whatever they're called.
But if you let me do your reg data returns, you two, your fees would drop off. It's just amazing.
God forbid. But no, it is worthwhile. Good point, Nick. Flagging up a good news story that's
very good news.
Again,
story.
interestingly, relating it back to the conversation a minute ago. Advisors culling their clients, and yet most of them would have experienced material reductions in their regulatory fees and costs. So interesting. Maybe it is a dividend. Maybe we will benefit from ongoing increasing standards. Long may it continue.
Okay, storyteller, we're sticking with you for this Truflation.
Yeah, this is something that really it commands more of my attention than it should do. I'm going to mention it a bit later on as well in the Culture Corner. I think fundamentally we all agree that clients and ourselves and the people we advise, the biggest challenge is not beating the market. We're not trying to beat the market all the time. Like the vast majority of the investment industry will have us believe. Massive marketing industry with an investment management bit tagged on. You don't need to beat the market. You need to capture market returns. But what you need to do is to preserve your purchasing power in real terms. The cost of living for every human being, the way things seem to work in the Western economies is the cost of living goes up every year. We did talk about this briefly last time, didn't we? About inflation. I mentioned getting a personal inflation rate, working out what your own individual inflation, because it is depending how you consume or what you spend your money on, etc. But I came across a website recently called Truflation, which I think is a US-based company, but it does have inflation rates for all sorts of places around the world, including the UK. They're quoted, and they are of the opinion that their data is more accurate, and you can put in certain information about your own circumstances. But they're quoting an inflation rate of 37% since 2020. So in those 4 years, the Truflation inflation rate has been 37%. So a couple of points about that. One, if you plug your data into the Bank of England and get a CPI figure, they say 23%. So back to this, whose number is correct. And secondly, so what that means is unless your wealth, assets, investment, pension, or whatever else has increased by more than 30%, 37% net of all fees, costs, and everything else in the last 4 years, you've gone backwards. You've lost purchasing power in real terms. Brings us back to all these questions, keeping money in cash because you were getting 5% in cash accounts, holding a high proportion in bonds. It's kind of just a repetition of the stuff that we tend to say. But that's quite hard hitting. I just thought when I read that 37% over the last 4 years, if you haven't achieved that, you've lost money. Interesting.
I loved, Alan, in the last episode, the personal inflation rate. And this is kind of linked to it, I suppose. I actually said it to a client after our last episode. And I said, I claimed it. And I went,
I was going to say, you didn't steal an idea, did you, Carl?
It's not like him.
Yeah. I like to call that your personal inflation rate. And
That's amazing.
And the client said to me, you took that from Alan Smith. I listened to the podcast.
No, busted. Brilliant.
Really?
So do you remember you boys said, don't be stupid. No clients will ever listen to that.
Yeah.
They do.
Hilarious. Busted. Careful what you say.
Busted. It would have been fine if I didn't claim it myself, but when I said I like to call it the personal inflation rate.
But nevertheless, do you think that's interesting? One, about the quoted rates of inflation that government or whoever it is who give us, And it can't be accurate because it's a broad brush with a basket of goods and services that you may or may not consume. And secondly, that even then some sort of independent think tank has given a number which is about half again higher than what the official rates are.
Well, in terms of our day job, this is so important, and this is why I think if you're using the government target of 2.5% as your assumed inflation rate in your cash flow models, you need to have a quiet word with yourself. I mean, CPI is just bullshit. Our RPI is bad enough, but CPI is just rubbish. It assumes you do all your shopping at Primark, and you eat off food bought at Lidl's. It's nonsense. So my assumed growth rate is 4%, which is 1.5% over the government target, and 4% is obviously light compared to what it's been in the last 4 or 5 years or so.
But in your financial forecast, it's the relationship between the numbers that's more important. But I know what you mean. Just a discussion. So the real return
real growth return is about 2 to 3% depending on your asset allocation. But you need to have a strong understanding of inflation. And, so holidays tend to go up, I think, more than just CPI, school fees, that kind of stuff. Kind of gym memberships, the things that the aspirational things that perhaps the people that we help service are more likely to have do not go up by bloody CPI or anything close, and haven't done for years. Forget the recent splurge inflation.
Holidays to nice places.
The cost goes up. But just your lived experience. Anyone who goes out and buys lunch.
Alan, red flag, mate. All experiences lived. Do not use that phrase ever again. Continue.
10x.
Inflation
is that on the banned list as well?
Just get them all out now, mate. He's on a roll.
Lived experience.
Inflation is the real financial dragon that we're trying to fight for our clients. And again, journalists.
But isn't this the point? And we keep coming back to it, and we keep getting sort of shot down in flames and the rest of it. And we talk about capacity for loss, capacity for risk, all that sort of stuff. Look,
their guns are facing in the wrong direction.
Your life won't be as enriched and everything else in the future as it is today because of this thing called inflation. And don't necessarily believe all you read about the published data. So I just think we can all have better quality, like you did the other day, Carl, stealing my idea, better quality conversations with clients. Why would you not err on the side of caution, assume that 2% is not a reasonable rate to expect? And why would you not aim for an investment strategy that's allowed you to significantly, based on 120 years of data, outperform any prevailing rate of inflation?
Okay, point well made. The bigger question that the Trappists are asking out there is, who did Alan Smith steal it from? But we'll come back to that maybe in a future episode. Let's have a look. Wodge, budget. Oh my God, budget. Don't. Go on.
Yeah, I just said I mentioned it. So budget is coming up first week in October here, and they're doing what they normally do. They're putting it all out there just to test the water. So the standard fund threshold for pensions is likely to be increased. Exit tax, unfortunately, they've put it out there and they're saying, probably not, so that we have a discrepancy. I mentioned that before. But the interesting one for me was the inheritance tax threshold. So earlier on this year, there was whispers amongst some well-connected people in the tax community that the inheritance tax thresholds were going to be reduced quite significantly.
Wow.
Which led to a lot of people doing a lot of things to try and get ahead of it. And obviously, right, when they sent that out, people were going bananas. So the politicians said, right, Feck that, lads. We can't do that. We need to go the other way. So now all of the media stuff that's out there about inheritance tax is that the thresholds are in fact going to be increased. Anyway, point is, they just test the water with this stuff. We know that. So let's see what transpires. But my point that I just made earlier on, I'd hate to be a DOI investor who's at the max in their pension fund, who's looking to withdraw money from their portfolio, who's looking to pass money on to their estate. You can't possibly do it yourself.
Nick and Alan, do you remember when it was mooted that the pension was going to be able to hold any asset in the UK, like art, cars, residential property?
The
world went insane for about
Absolutely
3 months.
Nuts.
And then they went, you know what? No, we're just scrapping all of that. Like,
this is a bit of a shit idea.
The carnage is going to be caused.
In the pantheon of shit ideas, that was a really shit idea. Okay.
Yeah.
All right, good stuff. Thank you.
But this is a good point. Obviously, we are facing a budget in the UK. When? September? Coming up quite soon-ish.
It's going to be big.
And this stuff has been set up. It's interesting, isn't it? Obviously, we've got a new government in place here, so they can test things out early on.
I think we'll move along, Alan, swiftly.
Yeah.
No.
We're only protecting you here.
No, but just saying that one you mentioned, inheritance tax. That is the one every client you speak to, they just dislike it. You know, they can live with income tax, capital gains up to a point. Inheritance tax just seems to generate quite a lot of emotion. So it's quite.
I think the marginal rate of inheritance tax in the UK is not that high. You know, when I sit down with a client who's got a few million quid and they're going to be paying 3, 4, whatever it works out to be, and I say, look, the overall marginal rate now is like 12%. 40 is the number that gets applied against, but the overall marginal rate is like 12, whatever the number is. And it just de-stresses them. And I think, well, that's quite fair. Yeah, I'm going to write a big check.
It's that
the marginal rate is low, and it's never quoted.
Why is that?
Gets,
because of the thresholds, is it?
Because the way it works out. You know, you can have like 3 million quid and only pay, I don't know, 14% overall. It's 40 on the number that gets applied to, but the marginal rate is less.
It's a tax on stuff that's already been taxed once. That's what grates with people. That's the mental.
Our rate used to be 20%, now it's 33%. So like there's people.
Sorry, Carl. Ours is 40 on the amount that gets caught.
I get you.
But I always quote the marginal overall rate with clients. And when clients got large pension pots, it can reduce down to about 12 or 11%. And then they go, not bothered about it. Let's just grow the wealth, pay the
it's a great reframe, and to all my clients listening, I'll probably use it.
It's very good, Carl. Very good reframe. Marginal overall rate. No, seriously, it's a massive stress for clients.
I love it.
You know, we're trying to remove their financial anxiety. They come into the meeting and go 40%, 40%, 40%, and you work it out and you go, it's 12.5%, and they go, well, nobody's ever told me that. That's how it works out. Yeah, get it playing.
Andy, the ultra crepidarian Andy. He knows about everything, Andy. Can't be told anything. His name is Andrew Hart. Andrew Hart!
It's getting worse.
Right. So, where are we at now? Yes, so Moneyvator, really good site, moneyvator.com. All these things we're talking about, Trappist, there will be links in the so-called show notes, but I would highly recommend you sign up for the moneyvator.com related email. Comes out 2 or 3 times a week. It's UK focused, which is really refreshing and nice. And they're always putting out great stuff. And so in this kind of world of tumult that we're apparently in at the moment, everything's going on, and a lot of it isn't particularly pleasant. You'd think gold would be the asset class that would stand out. And Moneyvator put together a very good little piece about US asset classes, both in dollars and revalued to sterling, over the last 10, 20, 50, 90, and 124 years. So we're going back to 1900 in the longest instance. Just how equities have fared against government bonds, gold, commodities, and cash. And over all those time periods, 10 years, 20, 50, 90, 124, gold lags equities in some time spans by a considerable margin. The longest margin of all, 124 years. So imagine it's 1900, we've got King Edward. And coming down the barrel at you, coming down the tunnel, you don't even know, 2 world wars, a Great Depression, Bay of Pigs, a near nuclear war in 1961, high inflation in the 1970s and 1980s, gold crisis, everything since then, everything we've had in this decade, aeroplanes meeting tall buildings, the on ripples from that. S&P has returned 7%, gold 0.7% in real terms. It just continues to stagger me.
Was that the year you were born, Nick, 1900?
No, I was in 1903. 1903.
Nick, can I just...
You're looking good.
Can I just counter that? I want to read a quote to you. We currently hold... blah blah. We also hold gold, which has done very well this year despite lower inflation as central banks increase their holdings. After being very underweight bonds for several years, we rebuilt that allocation last year. Blah 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 blah. So, what about gold this year, Nick?
Gold, shiny.
Is this from the Metis Norway monthly, weekly investment update?
No. This is my meat and potatoes. I actually did some research this time, guys.
Oh, nice.
But this is one of the... This is 6 experts telling us what we should do in our portfolios. And I'm going to get in big trouble when people realize who this expert is. But anyway,
Good for you.
Keep your powder dry. We'll talk about it in a minute.
Yeah.
But just the long-term primacy of equities, basically over most serious long-term periods, it just knocks everything else into a cocked hat. And the 20th century was not a barrel of laughs, and the 21st century's had its moments already.
But since last Monday, gold has been a good idea.
Yeah, fantastic.
Okay.
Well, I think that's the point, isn't it?
I think this evening it could shine for a little period before rolling back in the morning.
Exactly.
Around lunchtime, it'll probably oscillate back the other way. We'll get a secular movement out of counter rotationals.
Right,
Alan. Bollocks. Right. Let's crack on.
We were talking earlier on about you talked about the CFP, Carl, and as a qualification and a sort of study mechanism. I just saw this. I mean, you won't mind me sharing it. Nick was invited to become a chartered financial planner, wealth manager, chartered something, as a consequence of being at the job for a few years. This is the point. It's just got an interesting development that we've now got. There was a time when no one had this thing called a chartered. Now, Carl, I think you're familiar. I don't know if you have it in Ireland, but
all I remember from this group is proudly uncharted.
Yeah, proudly uncharted, exactly. But in other professions, so notably accountants, a chartered accountant, it tends to be one of the more qualified, better, as opposed to some of the other options. Chartered surveyor, chartered engineer. It is a badge of quality. It's generally perceived by the public and those who didn't know too much about it to be chartered. So, what I do know is some people have done a lot of work to get chartered, and people are still doing it and putting a lot of time and effort and energy into getting qualified. But I'm just throwing it out there.
Do you not think experience should count for a big? Do you not think experience should count for a big chunk towards it?
So I don't know what the metric is. How many years do you have to?
I don't. So Nick, do you want to explain what's happening?
Yeah, so Nick has been invited to become a chartered financial planner without doing any exams or
and he didn't want to
qualifications.
pay he didn't want to pay the 55 quid.
If that's truly what it was, I'd be happy for it. They give it to me. But the CISO, the CFP as was, that you're certified under their route, aren't you? You're not chartered. So this is a new title they brought in. You are chartered if you go down the CII route. So I think it's just the CISI having a little bit of trolling of the PFS and the CII. And saying,
I think you are chartered. They've now got this word. Chartered. I believe they've got chartered.
I thought it was the CFP was certified.
The CFP, they don't own that. CFP, as we've already talked about, is a global. I think US. I think there is the FPSB, whatever you call them, that own that license.
I did have the CFP, and the CII have the chartered. I thought.
Yes, correct. That's what I'm saying. Yeah, if you pass the exams with the CISI, you become a certified financial planner.
I think,
certified financial planner. So this thing is
that's
not equivalent.
correct. But you can also be a chartered wealth manager.
Yeah, that's
a new invented thing.
Yes, I think that's a new thing that's come along via the CISI. But
it's not their equivalent. The certified.
It's called grandfathered.
It's dull, isn't it? It's kind of.
Yeah,
so what?
So Nick, are you going to do it? You're going to become a chartered?
No,
are you going to be still proudly unchartered?
He doesn't want to pay the 55 quid.
You can probably do it.
Is that what it costs? 55
quid. They'll say you can't use this.
Kids run over burning coals to get that designation, and Nick doesn't want to pay 55 quid.
Yeah, but it's not the designation. It's not certified. It's something.
Are you still proudly uncharted, Nick?
I think it's chartered wealth manager, something like that.
Are you still proudly uncharted, Nick? Let's get that on record.
Right, let's move on.
Yeah, he didn't commit.
I didn't commit.
Keeping it up his sleeve, keeping his options open.
I haven't done it.
Are you going to?
Give me a reason why I would do it, and then I'll think about it. Right, Wodge, mind-boggling. You, in many ways, and also Irish banks.
Bank of Ireland, AIB, both reported their profits for the half year. Remarkable coincidence. They both reported 1.1 billion in profits. Remarkable coincidence. Both CEOs came out and bemoaned the pay caps for bankers. You can't make more than 500 grand. That was a thing that was brought in after the Irish people had to bail out these two banks. And both bemoaned the fact that it's the pillar banks paying the bank levy. So it was just remarkable coincidence that all these things happened at the same time.
So is the CEO salary capped at 500k, Cole?
I think so, yeah, and he might be allowed to have some bonus or whatever. But anyway, It's 500 grand. It's like,
is that why you haven't gone into banking?
He's not chartered.
He couldn't take the pay cut.
Bank of Ireland, shut up. Bank of Ireland has 80 billion on deposit, and Mr. O'Grady, who leads the Bank of Ireland, admitted the bank was outperforming its targets on returns, partly because of the slow rate of movement of deposits into higher yielding accounts, which they have. And he then went on to say that, they're hoping that their wealth management arm could capture some of these deposits. I just cannot understand why people aren't looking for real financial planning from real financial planning firms. 80 billion on deposit. The mind boggles.
Well, that's good news, Carl. Some of it will trickle into the independent sector.
Yeah, look, the Revolut have great TV ad at the moment that the Irish bankers don't like them, and it's a funny ad. But Revolut are coming for them, and come on, Revolut, and come on, everybody else. Good. We need competition. Competition is where all the pencils will be sharpened and the consumers will gain.
For sure, but there's a real recurring theme all the time, because if you can get what rate of return can you get in these bank accounts now? Still pretty decent on that at a headline compared to the last 15 years when it was 0.
3-4%.
I think his point is that they're paying that their net interest. What's the phrase?
Margin.
Anyway,
their margin.
It's not margin, but anyway, yeah. So most of this money, the 80 billion, is on 0 or very low interest rates.
People haven't moved it up to a higher rate. It's just
which is
just financial lethargy, isn't it?
That's how they make their money on the spread.
As a result,
that's how banks make their money. They pay
they don't reach out to their clients and say, "Do you know you can move it to another account? You get a better rate of return."
I think the typical margin in the UK is about 2.2%.
Yeah, they're putting them in touch now with their wealth management divisions.
Yeah, I bet they are aggressively.
To try and make even more money from clients than they already are.
Okay, guys, we've got about 7 more points to get through in topical tidbits, so we're nearly 37 minutes in. Right. Okay, quickly, storyteller, Verve.
Yeah, just want to do a quick one. Haley from Verve reached out to me this week and asked if we'd be kind enough to remind everyone. We mentioned this before. They've got this advisor incubator program. It's the last cohort is just being launched or closed in the next couple of weeks. Go online. I've posted the link. It looks amazing. It looks really good. Anyone who is either thinking of starting their own advice business and or is maybe a one-man, one-woman band who wants to consider growing, scaling, and maybe hiring a few people. There's just so much available. And guess what? It's free. It is free. So much structure, support, advice, consultancy, all that sort of stuff. So it's their last one of the year, latest cohort. If you are remotely in that zone, either early days would like to start your own business or running a small company and you'd like to consider growing the company, get in touch with Haley and the team at Verve. Check out the link in the show notes. Thank you.
Okay, very good stuff. Ultra.
Okay, so this is Carl Walker, who's an English football player. He's going through a custody issue with, let's say, his previous partner. It's basically like a divorce, but they weren't ever married. And it's quite an unusual case because the judges decided to make all of the information public. And there's a link in the show notes. And it's quite a sort of easy document to read. Anyway, so it lays out Carl Walker's financial position. It lays out what the mother of the children has asked for and the sort of settlement that's potentially been agreed. It's quite staggering reading. All of the time, this information is private and is not made public, but the judge in this case decided to make it public. So it's a huge insight into obviously his financial position, his earnings, his assets. So there's a whole host of interesting information there for financial planners to get their nosy little eyes into. I'm assuming you guys are totally not interested in this story.
Correct.
Can I ask why did the judge believe this is in the public interest?
The reason why is because the mother, I think it's Lauren Goodman or something, she was claiming to the judge she wants this to be private, but then I believe she was feeding information to the press anyway. So the judge was like, well, if you're telling me to keep this private, but then you're doing this on the side, that's not the right way to do it. So the judge decided to make it public. It's a 30-page
that
PDF.
seems harsh. This is obviously a highly personal event.
I think the judge decided that it might be in Carl Walker's interest to make it public. She was.
Well, it's disclosing all his earnings and everything, all his.
I mean, it was
done.
almost out there anyway with speculation and public.
So what? So have you read?
information.
I haven't seen it. Have you read it? What?
Yeah, his
What
assets.
can you share
total-
with us?
His assets.
Do you want to save this for your separate divorcing footballers podcast?
His
Set up.
assets total 26 million. It's split down, but just the way the judge talks about his assets and money, it's a really interesting read. So do check it out if you're interested in this stuff. Yeah, I mean, obviously she was asking for a lot of money per month, and obviously I don't know, like 12.5 grand a month net, which is 25,000. And then her side was saying, obviously this seems like a real significant amount of money for the mother, but for the father, it's insignificant. It's just quite interesting the way they talk about stuff, and the numbers are quite large. Anyway, that's it. Unless anybody has any questions.
Nope.
Okay, next point. Hargreaves Lansdown. Ultra, I don't know if you want to get involved in this as well, but they are going to delist, and it's this continuing saga of the decline of the UK stock market. As these companies just cannot be asked. They cannot be asked with the regulatory burden, the DEI nonsense. I'm sure on Hargreaves Lansdown website somewhere there'll be a statement about slavery. These companies just cannot be asked with it.
Yeah, modern slavery
Peter
statement at the
Hargreaves just
bottom.
gets pilloried. He's a very successful man who just created millions. And just we look down on entrepreneurs, we look down on wealth creators. Governments arbitrarily raise corporation tax by a third out of the blue. And I can see why these corporations are just, you know what, sod this, we're not doing it. So
Yeah,
do you have any views on it?
couple of points on this. I think Hargreaves are an amazing company. They've opened up investing to hundreds of thousands, if not millions of people. Yeah, a couple of points. Obviously, PE are very active in buying UK companies because they believe they're undervalued. It's another great company off the FTSE 100. They're highly profitable. The founder, Peter Hargreaves, he's got a decent book called In for a Penny. He basically started off this whole DIY investing in 1981, sending checks in the post, and then Old Mutual came along, Scandi, and all this stuff. So it's quite an interesting insight as a history of this profession. Hargreaves are, I think, a great and efficient company. I've got an account with them. I've got an account with all of the online companies. For example, if you need to send something to Hargreaves in the post, you get the letter out. Probably said this before. You literally write on the letter, free post, Hargreaves Lansdown. It gets there. Everything. I mean, talk about low friction. Yeah, it's the articles that have written about it. We don't quite know what the new entity is going to be. I thought it's going to be the same platform, just maybe tweaks around the edges. The new CEO, Dan Ollie, he's come in and been quite guns blazing. Peter Hargreaves is just dead set on it being DIY, no financial advice. Whereas everyone comes into Hargreaves and go, look at all this money. Like, we can make a lot more money if we offer advice, but they can't offer advice at scale. So that's the thing that I think is quite interesting
you know what
to see if the PE company does it.
I'd go with a man who's made us 780 million quid. I'll go with his judgment.
He's worth billions.
I
both of them are.
I think they're really undervalued. Can you imagine? And again, I
think they're undervalued as well. Yeah,
bring out my old, my regular reference to AI. Imagine the data that an organization like them's got, that Hargreaves Lansdown, over the however many years have been going, and all of a sudden they can pinpoint and deliver highly, highly personalized services.
So efficient. They're pretty much run from one office in Bristol.
Yeah, I think their value could be 2 or 3 times what their current listed value, and I think it's a smart
Excuse
move.
me 2 seconds, guys.
Where's he going?
He's off to get a package or something. No, it's all right. We can continue without him.
Right.
Yeah.
So
it's
that is interesting, and they're not the only one. There's several listed companies have been or in the process of being taken private, and private equity guys tend to be pretty smart.
Yeah, they're
just looking and saying this
is
is just massively undervalued. We can take this off, take it private for the listed price, tidy it up a bit, apply a bit more, whatever thoughts, ideas, technology.
They've bought it for 50% of their share price peak. Keep it simple. The share peaked to £22 a share. Now they're buying it for 11.
Yeah.
But
it's a steal. But I guess the shareholders have had to vote it. They've accepted it.
Can they deliver regulated financial advice, financial planning on a mass scale? That is going to be the big question I think they're going to be asking themselves. But yeah.
But do they need to?
Nonetheless.
Do they need to? They can carry on just doing what they're doing now.
That's what always the new thinking.
Something like that, they are fantastic. The demographics are hugely in their favor. There's huge number of people reaching retirement that want to do DIY or at least partially DIY, want to invest, want to save. There are tools. I know a lot of advisors, I know you guys do as well, just use their part of your job as well. Use some of their calculators, some of their tools.
Yeah, they're just
the
decent.
calculators are
They're just decent.
Very
They start with the client in mind. You know, they don't add extra complexity for the sake of it. Even when you need to fill in a new form online, it will pre-fill your information and the date.
Yep.
You just do a simple, all the other crap platforms will make you print it out, 80 pages. Yeah, anyway.
Okay, still with you, Ultra. FTSE 100 pension scheme. I'm going to
it's
try and
Carl
read
now.
this, but just...
It's Carl. Black Bee?
No, it's not. Carl's been cut out.
Oh.
And that's Carl said to do that. So
Okay,
back
fine.
to you and FTSE 100 pension schemes. I couldn't read it because it's behind a paywall, so I don't know
This is quite
what you're
simple.
going to say.
This is quite simple. It's an article in the Times. It's just outlining and listing the pension contributions from the FTSE 100 companies. Like, what's the best FTSE 100 company to work for if you want to build a huge pension? And the discrepancy is enormous. Keep it simple. If you work for the worst one, you can have a pot of 400 grand. If you work for the best one, you can have a pot of 1.5, 2 million quid. There's a link in the show notes. It's maybe behind a paywall. I think that the highest payers are Shell, 20% non-contributory. My brother works for one of these companies, and what he told me is the contributions is not what they've listed, so I don't know how accurate it is. Anyway, any points on that? I'm assuming not.
If you really want the best pension contribution, join the public sector.
Great.
Oh.
Okay, final point, just another plug. Genuine, Hum London has only got 15 tickets left, so it will sell out ASAP. So if you're on the fence, no BS, buy a ticket. Back to you, boss.
Excellent. Thanks, chaps. 46 minutes. Not too bad. We went through a lot there. Okay, so I think it's time to move on to the meat and potatoes. I've got oh, no, it's coming. My media board suddenly went blank on me and I had a mini heart attack. So, something called the Japanese yen carry trade has unwound. It's probably even duller than it sounds as descriptive. Don't really understand. Well, I do understand it, but I mean, anyway, there has been some volatility in the market. As we know, volatility goes both ways. Mainly, it goes upwards most of the time, but sometimes we have downward volatility. And over the last couple of weeks, we've had downward volatility, especially in Japan, but then that translated across to here and then to America and through Europe. And what has amazed me on this is the media response to this volatility. So for the meat and potatoes, I think we have a two-part approach to this. What was the recent small decline, and how was the media reaction to it? And what does that foretell us about what's going to happen when we have a proper decline? And the second part will be, what are we doing now, and what should we be doing now to really lay on thick the vitamin D and educating our clients? So Ben Carlson, A Wealth of Uncommon Sense, put out a piece last week, and he reminded us all that the typical S&P intra-year decline is 16%, has been for this century and was for most of the last century, 16%. Now, I think the S&P is down around 5, 6, 7%, given all the recent movements, because it went down, then it went back up again. But the way the media has reacted to this perfectly normal, half the average typical intra-year drawdown, it's reacted to it as if it's the end of times. And this got me kind of thinking a bit, because we haven't had a real nasty grizzly bear market since the great financial crisis, whatever you want to call it, the credit crunch, 2007 to 2009. We had the Wuhan bedwetting, but that was a month, and at the time we didn't realise it was just a normal flu.
I think that's a serious bear, Nick. That was very extreme, but I know what you're saying. It wasn't prolonged. I think that's a serious bear. COVID is a serious bear. People were seriously panicking. So we were on the front foot, but fine.
Okay, that's not my experience of it. And we've had some very short bears since 2007-9, but they've all been 11 months, 5 months, 1 month. They've not been, and they've all been 20% to 30%. And of course, in 2007 to 9, a device came out, funny enough, in June of 2007. Steve Jobs saw that Nokia had invented the smartphone with a touch screen display and thought, I'll have some of that and make it actually decent. And he launched the Apple iPhone in 2007. And back then, nobody had it in the great financial crisis, pretty much nobody. In terms of global population, smartphones just were not a thing. Now, I don't know anybody who hasn't got a smartphone. My son is 22. He's had a smartphone for at least the last decade, and he upgrades every other new issue of Apple. I've just come back from Spain with my parents, 85 and 83. They both had smartphones for as long as I can. So these are, I'm sure we all know people in our own circles at both ends of life who've got these things. Nobody had these in the last serious bear. And I just think that when the next bear comes, it's going to be unlike any other bear that any of us have experienced. Not in terms of its severity. It could be 30%, 40%, 50%, 70%. and not in terms of its length. It could be a year, it could be 3 or 4 years. It's going to be the reaction to it. It's going to be because we've got these bleeding devices in our pockets with Instagram on and TikTok and X and everything else and relentless news notifications, because judging by how the media reacted to this very recent, totally normal, gentle downward volatility, the next proper bear market is going to be unlike anything we've ever seen in terms of how the media portray it. And let's not forget that the media from 2007 is long gone. Back then, people still actually bought newspapers. Some newspapers actually made money. The legacy media now is just for clicks, right? It just wants you to click and read the banner adverts. So they're going to bombard you with bad news as and when it comes. So I just think, I don't know. I was just astounded by the reaction to it recently. I just think, frankly, when we get the next bear, it's going to be a massive. So the second part of this conversation really is, okay, we all know that the time to educate your clients is when times are good, right? You know, it's the cliche, but you do the iceberg drill when the boat's moored in the harbour. You do the fire evacuation from the tower block when there's no fire, right? You don't wait till there's a fire and there's smoke and there's everyone panicking, jumping out of windows. It's too late then. So we need to be stepping up our education, not just the quantity of it, but the quality as well. We need to be on the front foot with this kind of stuff. If, like me, I know, Andy, you might think it's slightly different, but this last significant bear that people remember was the Great Financial Crisis. That ended in March 2009. That's over 15 years ago. I'm not saying there's one around the corner. What I'm saying is it's likely that we're probably overdue one, given that typically in the last 54 years, there have been 12 bears. We're overdue one. We need to start educating our clients now, being on the front foot and being really aggressive about it, because the four of us know, and most of the trappists listening to this know, that our value comes from managing our clients' behaviors. And now is the time to help educate and manage our clients' behaviors, because the next bear will be unlike anything we've ever experienced, not because of the quality of the bear itself, but how the media will just go full on nuts. Gents, any thoughts?
That was a great introduction. Does anyone want to go or not?
You go, Andy. I think we've all got things to say, but you go next.
Nick's hit the main nail on the head. The media need to sell advertising, so they're going to be, just headlines coming out of their ears. Bear markets are good news for investors who are contributing monthly in their saving stage of life, which is the majority of investors. But that's never reported. Bear markets are where the great advisors, stand tall, as Nick mentioned. All of the previous vitamin C we've been giving our clients, the coaching during all the live conversations we've had with them. And they need to know the numbers going in. The market generally advances 75% of the time and declines about 25% of the time. That's baked in generally. And the minus 15% happens every year pretty much. Minus 16% has been quoted earlier on. But at least every 3 to 5 years, expect at least double that. We just don't know when it's going to come. So it is also important to discuss these things in the welcome meeting. I think it's the most important thing to discuss in the welcome meeting is what's going to happen with what's happened with investments historically. There's no facts about the future. And, just drill it into them, I suppose. That's it. Who's next?
I don't know if you guys have heard of someone called Jonathan Haidt.
Yes, he's got a new book out about the anxiety generation.
Got a new book out. I watched him on a podcast last night, and I got to tell you, it's depressing. So he's a psychologist, a therapist. His focus is teenagers, I suppose.
Yeah, teenage girls.
And he talks about, again, I'm never good at remembering the Gen Z, Gen this, Gen that, all the stuff, and when people were born at certain times. But I tell you, as parent of teenagers, as Carl is, and Andy will be, I was just depressed by it because, and he just goes through exactly this. Nick, you alluded to this thing when the iPhone came along, but it wasn't just the iPhone, it's when the platforms then understood that it was an advertising model. That sort of, and so all the algorithms are designed to keep you on the platform. And what keeps you on how are human beings? We react to threats and problems and things. If everything in the garden is lovely, we are going to go and do something else. We don't need to keep on the platform. So everything you do is doom and gloom and negativity and all that sort of thing. And you're right. When you mentioned this, Nick, the other day about we should have a conversation about, I thought, wow, you are right. Because not only are children going through just such a period of anxiety, and unfortunately it's coming, teenage suicides. It's an absolute mess. And I'm also sorry to say that Jonathan Haidt had no good news. He said there is no solution short of just taking these devices away from people, which is impossible.
Well, he was saying
much.
about children not being allowed a smartphone until you're 14, not being able to sign up to social media until
16,
you're 16.
he said, yeah.
I said not being able to sign up to social media until you're
Good
16.
luck telling your 12,
Yeah.
13,
Yeah, no, I know.
14-year-old
No,
daughter you
it's
can't have a
impossible.
When
phone.
all their
It's impossible.
friends are on it. It's just so.
Can I?
Yeah,
Can I just shoot my wife in
brilliant.
here quickly? Sorry, Alan. My
go ahead.
TLP at her school, they're just bringing it in. They're not allowing mobile phones into. You can bring the old-fashioned dumb phones. So you got the kids, but they're banning it from next year, academic year.
This is the movement.
It's gone down very well with the parents who are just crying out. For this kind of
I actually heard of a school recently. On the outside of the locker, they have a little clear pocket. And your phone has to be in it, right?
Yeah.
And if your phone isn't in it, your parents are called to say, why isn't Johnny's phone in his pocket? And it's locked. So it has to be there for the whole day. So they can't have the phone.
They'll probably just buy a second phone. I'd buy a second phone. I was a little shite like that.
Yeah, well, let's assume
I'd be selling phones to the other kids.
Yeah. Just a fake. Put their own fake phone in the thing and crack.
Fake phone, yeah.
I remember when my brother banned his little boy from YouTube. My little nephew worked out that you can go on YouTube if you download a keyboard. My brother was like, "No, I've locked YouTube down," and he had this special keyboard that you can. The kids, they are innovative.
Well, that's the thing. You've got generational differences, but I think the point's well made, Nick. That's all well and good, and it's a freaking slow motion tragedy actually playing out in front of our eyes, and I'm struggling with what to do with it, and most of us have got issues and challenges with the whole thing. I haven't read his book actually. I think I'm going to buy his book and read it, and I'd probably recommend anyone listening to this. I think he offers some guidance, some suggestions, something out there rather than just let the whole thing play out. But this is the point. I mean, as he talks about how the way the humans operate and bullying in schools and stuff. Anyway, but apply that to our world and dealing with clients. Now, obviously, our clients are more mature than that. They're not children, by and large, but nevertheless, they are impacted by that because everyone is on Facebook or Instagram or Twitter or LinkedIn or whatever. The 90% of people spend some time on it all the time, and the platform, everything the platform wants to do is keep you there. So it is a real challenge. And probably the single biggest thing, the biggest challenge we've got, and maybe you're going to speak about this. I got ahead, Carl, you might want to talk about this, so I'll leave it to you to explain in more detail. The biggest challenge is anticipated timelines. Because it's like the conversation about gold or whatever. People are talking about literally this quarter, this month, or this whatever, versus we are multi-decade investors, multi-decade intergenerational investors, and that's the mismatch.
Yeah,
that's the entire thing. We know that over the next 30 years, looking at 100 years of data, equities are going to outperform gold. But over the last quarter, gold may well have outperformed, and this is what captures the attention. What are your thoughts, Carl?
Yeah, so this little very minor blip happened on Monday, and it was a bank holiday here, which would be very surprising to you guys, but we actually had another bank holiday here. Now, on this particular bank holiday,
sunshine.
I had spent, wait till you hear this, right? I had spent the Friday, the Saturday, and the Sunday night in a tent at a music festival, because that's how I roll, and it had pissed rain on the Sunday, and it was absolutely pissing rain on the Monday. So
was it romantic?
Well, thank you, Aoife, for inviting me. I loved it. So I got into the car.
I like that drop. Play that.
Questioning every single life decision I had ever made, and I decided I'd look at the markets because that's what you do. And went, oh, Jesus, Mary, and Joseph. So the first thing I say is we have to understand people are in different places at particular points in time. And my anxiety levels rose. So I'm not going to tell anybody that you're stupid or it's ridiculous that you felt anxious, because mine did. Now, the previous 3 days probably led to my anxiety levels being raised anyway. However,
did you have a touch of anxiety?
Maybe, perhaps, right? But my second thought then went immediately to Mr. Morgan Stanley man that I mentioned in the previous episode, who told us all that it was going to go down 10%. I said, he's going to be on to me. Morgan Stanley are actually going to be on to me going, I told you. But look, that's just, I suppose, try to describe, the range of emotions we're trying to deal with people. But I then, when I did get back to the office, and the Business Post led with an article as follows: market turmoil, 6 experts on what happened, what to look out for, and how to adapt your portfolio. And then there's the 6.
Jesus.
And that was on the 7th of August. Now, also, being totally honest here, if the Business Post rang me or anyone in Metis and said, you want to contribute, we would have said yes. So let's be totally honest here, right? And we would have said, look, these things happen or whatever. But we would have been part of the article if they asked us. That was the 7th in the Business Post, a really cracking newspaper. On the 8th in the Business Post, market wrap, S&P 500 notches biggest rally since November 2022. So this proves the point that, the papers are looking for sensational headlines. They found 2 different ones, 2 totally opposing ones in 2 consecutive days that would have confused the shit out of every investor. It was like, should I have gone out? Should I get back in? Or, so these things they're just going to happen. We can't help this bloody phone in your pocket, right? Because idiots like me will sit into a car after a festival and look at the markets because we're human beings, because that's what we do, right? And so, but did we at Metis get any phone calls about, oh my God, right? We didn't. However, do you know what we did get? We got a few with people saying, will I throw that extra few quid in now? Right. So I hope we are doing the coaching, the mentoring.
That's brilliant.
Yeah, the Vitamin C's.
No, it is. But I take your point totally, Nick, that this is very mild stuff. And if some big stuff happens. Now, Andy's point about COVID being, a big bear, it was. My experience, though, was people were more interested in am I going to die or not?
I get it.
That's what I tried to say.
So that's why I don't think we got the kickback necessarily.
But because it was so unique, I still has to have a tick in the bear box, in my opinion. But
100%, 100%. But look, I don't think we can do, if you're doing real financial planning, if you're doing, if you have an investment philosophy that you can stick to, what more can we actually do? I don't know. Like what's the answer to all of this is actually, we spoke about it in episode 50. So we spoke about what to do in this scenario 2 weeks prior to this happening. And I don't know what more we can actually do.
Something
I really don't.
Coming to my mind, it's sort of client screening. I can't think of a better word. Because if you do have those nightmare clients that going in that are going to be a nightmare, I mean, it's technically your fault. So I think we're all in a somewhat fortunate position that we can take on clients that we think are going to be well behaved and we think are going to be teachable. But if you've got clients that are just unteachable and a freaking nightmare, just sending you links and just panicking, and it's a complete nightmare. I mean, happy clients, happy business, happy life. That's the order. And if you've got unhappy clients, unhappy business, unhappy life.
All those things are true, but I really get the sense of this. It went freaking, it exploded for a day or nearly a whole week for nothing. It was a just small blip, the entire thing. And this, if you get a minus 40% global equity market experience like we had, 2007, 8, I dread to think what about, and even the most rational, cool-headed person, because we didn't have this type of media. It's not just the phones and stuff. It's the type of media, the way that people consume media, that everything. And in days gone by, when as Nick said, you bought a newspaper, there was some sober reporting on this sort of stuff.
Yeah, you had like the front page of Yahoo.
It's not in the interests of those who create this modern form of media to make, to give sober reporting. That doesn't keep people on the...
they don't care about your long-term life savings. They just want to sell eyeballs and
the MSCI, their interests are completely misaligned.
I think
they're interested in the next 3 minutes, not 30 years.
Exactly.
Yeah, but then I think the Nikkei fell by 12%, was it, or something like that?
Yeah, I was going to say
that
was
went
big
back up.
news.
Yeah, that was exciting.
And the thing that I found funny about that I sent you guys the other day is the Nikkei. The Japanese stock exchange closes for lunch. I just think it's so awesome. It's so traditional. I could just imagine them all going for civilized, all going for lunch, 3-course meal, red wine, and then going back into the trading floor.
Yeah, I'm not sure the Japanese are quite so hedonistic as perhaps we are in the West, but it's not. I mean, it's like the Belgian government didn't exist for 3 years, did it?
They closed for
and
an hour.
Belgium ran perfectly fine with that as government. You just don't need, don't go to lunch. Go to lunch for years. Everything will be fine. I mean, the MSCI World, which is my preferred index as opposed to the MSCI, that fell in those from November 2007 to March 2009. Peak to trough decline was 59%.
Incredible.
Can you imagine these vultures now? When it happens again, it might not happen in our lifetime, but it's going to happen again.
Yeah.
Can you imagine the tsunami of just garbage?
It doesn't bear thinking about, but as I say, this is our clients will be overwhelmed by this volume of news and media.
That's a great
point, though, because
great financial advisors earn their money.
But you're going to have to be even more on the front foot than we've ever been before. And repeating this stuff.
Yeah, of course we do.
And
we're going to have to prepare for it. This is the profession we've chosen.
I'll tell you a very, very quick story, very quick experience. Now, just
play it, Nick. I need
really
to fill
quickly.
My water.
Now, really quickly, because.
Grab yourself a drink, a very long drink. It's story time with Alan Smith.
I was advising in the depths of that, how you just described it, Nick, 2007 to, I think, March 2009 is when things began to recover. And we were doing real financial planning, and we were building financial forecasts and cash flow modeling. And I remember, and of course, the media landscape has changed beyond all recognition, which is the entire point of this debate, this conversation. Yep. So I'm going to guess, can't remember exactly when it was, around in the D at the bottom, like 2008 sometime, late 2008. And I remember this lady coming in who was planning to retire, and she was saving a lot of money and doing her best. And I got on with her like house on fire. She's still a client now, I'm pleased to say. And she just came in and she was just all over the place. I'm in such a mess. And so I said, like, calm down. And obviously I'd prepped for it in advance, reran the cash flow from that bottom, in the bottom of the pit of the bear market. But I assumed normal growth rates, normal inflation, whatever. I didn't assume a bounce back. This was going to go bounce up again quickly. But from here, all the way forward until your anticipated retirement age. And what it said to her on this model was, if nothing recovered quickly, if we just got back to a sort of linear, sort of 3% above inflation or whatever return you could get, she might have had to defer her retirement by 2 years. This was the point. And she really liked working anyway. And she was and she said, that's it. We tested the models again, just sorted everything out. And she said, oh my God, if that's the worst in this, because she was just coming in for this media onslaught back in those days. She said, I'm just walking out. She said, you've taken such a weight off my shoulders. I was just so, I could never retire. Now, nothing could ever. And this is the point about changing the time frame. This is because she still had, anticipate she lives to 100 years old. She's still going to have like a 30, 35-year time horizon. If we assume that even though the market is cratered, you're still going to be, worst case scenario, defer retirement by 2 years. And I think that's the point we've got to do is, again, go back, zoom out. Remember to zoom out, even in the current circumstances. Quickly rerun your financial plan, run your model, and calm people down.
Point well made. Sorry, Carl, do you want to put your little dog on your lap? I'd like to watch that, and I wouldn't see you. You were going to say something, my friend, before Ultra and Alan had a little back and forth.
Yeah, I was going to say that we should all just make our points simultaneously, because I think that makes for a great podcast. Just keep talking all over each other. I think the Nikkei going down by 12%, that gave the media what they wanted. Like, whoa, this is going to be massive. And what happens if that happens again tomorrow? And this is the, so it's like, look, I hear what everyone's saying, but I'm just not bloody sure what more we can do other than what we are doing. And I think, as you say, the time to, have those conversations with the clients is at the outset. And we did, and listen to episode 50, because we did speak about that. We spoke about the maximum drawdowns. It was 60-40 and 80-20. And they are so crucial, because And it's not for the advisor, it's for the client to make sure that the client goes in and stays in.
This is it. This is it. I think the message I would, and I'm sure, I know you guys agree as well. I think we need to be upping. You know, you might want to have a little online webinar. You know, the next bear is coming. What are we going to do? And you just reiterate, we're going to do nothing, right?
Increase
but just get the stuff out there now.
dose.
Just work on that material and get it out there now. You know, 12 bear markets since 1954. Sorry, 12 bear markets in the last 54 years. And despite that, because of the bear markets, the MSCI World Index has returned 11.1% annualized. You have to have the bear to have the bull. Now's the time to tell people it'll be too late when the MSCI World has gone down by 30% and Robert Peston and Beth Rigby are telling your petrified clients this time it's different because they'll be selling online, they'll be clicking online and doing it behind your back despite what you try and tell them. Right.
I'll tell you a good one just on that, Nick. When we started our journey at Metas, we were doing blogs and whatever and trying to get a bit of traction, and literally nobody was looking at them. Or we did a webinar and there'd be like 6 people, 5, from Metas and my mother probably. And I wrote a blog then and I said, the stock market has crashed. What to do now? Right. And it was like just kind of tongue in cheek. And I got like absolutely tons of engagement. So, people do, they click on, that's just proof again, they click on the links.
Bad
but,
news sells.
It's not a bad idea. Do a webinar with, call it out. How do you feel reading that headline? And let's talk that through. Let's talk the anxiety through. Anyway, sorry.
Yeah. You might want to frame it, dear client, over the last few weeks, you might have thought that we'd been going through a really bad bear market. We haven't been. Let's just talk about what a really bad bear market looks like because there's one coming down the line. Yeah, well, catcher than that, but that would be generally the tone perhaps I would look to adopt. Okay, listen, we're at 1 hour 11 minutes. We didn't do a Trappist question last week because we were going so long. So let's do duty to our beloved audience and have a Trappist question because I can see at the front door there is Posty dragging the bulging sack of Trappist questions. You can submit questions, dear Trappist, by clicking on the link in the pinned X at the top of the Trap timeline on X. Also in the so-called show notes there's a recurring link for you to submit your questions in there, so that's all good and well. Let's dig out a letter and see who this one is from. This is from Jill Turner. Jill is on Twitter at JoinedUpJill. She's also on LinkedIn. Jill's question for the Trap Pack: so many videos about mouse traps. Still, I have subscribed now, so should be able to find you easily from now on. I have a question for Alan and all of you, really, on the back of his story about OBSR fund research, picking and swapping out funds at the bottom, etc. How did you handle the process of migrating your clients away from this fund picking and quarterly review model? You recount how you talk to clients through gritted teeth, and I appreciate that when working for an employer, the advice is dictated by the employer. But how did you go back to your clients with an improved solution after all your research and effectively say, it's still me, but now I know better? I think this will resonate with advisors who have left restricted networks and now realize they can improve upon the advice they gave. Enjoying your podcast, especially when I'm cooking dinner for everyone or going on my walks. Yours, Jill. Thank you. That was a very, very good short story, Jill. It sort of kept me entertained. It had a beginning, middle, and end, and a good theme. Alan, do you want to go first?
Yeah. For those that hadn't heard before, when I first started, we outsourced our investment fund selection and solutions to an organization called Old Broad Street Research, OBSR. I don't think they exist anymore. I think they were bought by someone else. And it was quite a good story to tell. And without going through the whole thing, in the aforementioned global financial crisis, 2007, 2009, they were as much use as a chocolate teapot. It was a pretty hopeless experience, quite frankly. And we and my colleagues and we sort of looked at this, and we thought there must be a better solution. We spoke to various people, and we built our own investment models from scratch, which were predominantly low-cost index funds, global allocation, etc. But to answer Jill's question, I've then got to go with our existing clients and say, we've got to change. We've got to change. But if you just did it all down and think, it wasn't as if we were moving from, recommending hedge funds and gold or anything else. It was a so-called asset allocation model. So there's two things, two practical things. One, I said, and all the conversations was, it's 80-90% the same, in as much as the variability in your future expected return is going to be largely determined by your asset mix. Equities tend to outperform bonds, but they're more volatile. All that is the same. Everything's the same. Not much difference. We're just being more efficient, is what I said. The other thing that we said as well, and I just got into this habit of saying to people, particularly those who were still working, ask, whatever profession they were in. Let's just say they were in the legal profession. I would say, has technology changed a lot in your profession in the last decade or so? And whoever you speak to, they go, maybe that's a bad example. But for most other people, they would say, beyond all recognition. And so I say it's exactly the same in investment and financial services. There's a lot of innovation. There's a lot of change going on in the last decade. I see it as our role and our responsibility to identify trends, opportunities, lower costs, but all that sort of stuff, and bring them to you. I didn't do it as a fait accompli, like this is what you're doing now. I said, this is what we believe to be a better solution, but it's 80-90% the same philosophy. We're just being smarter in terms of the implementation. And in terms of the practical, we did it one client at a time. We never did a massive sort of fund switch or anything. Just meeting. We had a great set of collateral, slide decks, presentations, all that sort of stuff. And we explained it all. And I have to say, the final thing was you're just discussing and debating the whole thing, and then you come up with, oh, by the way, it's half the cost that you're currently paying.
I was going to say,
it's like, all right,
I'm
fine.
sure you were pitching it at half the cost, yeah.
If you just told me that at the beginning, I just signed there. But I think that's the point. It's not much change, is what we're saying. We're just being more efficient. Is kind of the thought process.
Ultra.
I'm going to sort of answer this from a wider point of view, because as advisors, we all go through a journey. We start off at a certain firm doing it in a certain way, and then we move to another firm doing it in another way, then we maybe start on our own. We change all the time. I wouldn't oversell change to clients, because if you're doing a slight tweak or change and you're sort of really trying to pitch it and going through sort of 5 or 10 different things, I wouldn't oversell change. And also, you just say to clients, as time's gone on, my understanding slightly changed here, and I think there's a slightly better or different solution for you now. So yeah, the wider issue is don't oversell change, and just explain to them sort of clearly your thoughts and understanding have changed, hence your advice now has changed. So yeah. Carl, what
Voice, anything?
Just a quick one. I would definitely start the change with your new clients. Get into your rhythm, your cadence, understand kind of how to frame things, and then maybe bring it to your existing clients. Yeah. And other than that, I'd like to thank Jill for sending that question into Alan.
Yeah, well, it was, yes, Alan and to all of us. I would close this. I think it's one of those things that's probably bigger in our heads. Yep. We make more of it than we actually do. And we've said this before, but clients will, because it's you saying it, Jill, they will believe you, right? They don't understand half of what we talk about. And at the moment you go from saying, oh, we're going to go passive and small cap, they're already dozing off mentally. Yep. They'll just do whatever you tell them because it's you doing it. And I think the problem often lies in our heads. When the facts change, I change my mind. I think this is better for you. It's how I'm investing my money. Sign the form and get the hell out of my office. Okay, Culture Corner. Come on, let's do it. 1 hour 17. Kill me. Okay, I'm going first today. So I've just finished a book called Tuesdays with Maury. Maury Schwartz was a professor at Brandeis University in the 50s, 60s and 70s. And one of those beloved professors, apparently. His students just really liked him. They kept in contact with him after they graduated. He was this sage. He taught sociology, but despite that, he seems like quite a decent cove. Anyway, in the early 90s, he contracted this horrible disease called, what's it called? I can't even remember the name of it. Amyotrophic lateral sclerosis, ALS, also known as Lou Gehrig's disease, which it was contracted by this American baseball player who got it and died. And it's a muscle wasting disease, and you just basically your body just kind of just withers and eats itself. And when it hits the lungs, it's all over. You just lose fat. You can't walk. You can't feed yourself. You can't wipe your bum. By the end, your brain's still there, but everything else is just pretty much going. So Tuesdays with Maury is this guy, this ex-student of Maury's, who got in contact with him when he saw that Maury was not in a good way. And Maury was based in Boston, and every week this journalist would fly from Detroit to Boston to interview him. And it's just full of really nice sage. It's a sad decline because Maury knows he's dying, but there's stuff in there that we can, we work at this intersection of money and money and feelings and values. and dreams. And there's some good stuff. I'm going to read two bits out here. So Mitch was the name of the journalist. Mitch, if you're trying to show off for people at the top, forget it. They will look down at you anyhow. And if you're trying to show off for people at the bottom, forget it. They will only envy you. Status will get you nowhere. And that, which I think is lovely, and that's all part of the hedonic treadmill. I used the hedonic treadmill recently with a new client couple, really busy, high earning couple, but they're just spending money like anything. She's a partner now at one of the big 4 accountancy firms, and when you become a partner, your earnings pretty much compound at about 15% per annum until you're not a partner. And he works for one of the big management consultancy firms. They're spending money, and I said to her, this is the hedonic treadmill is buying things you don't need with money you don't have to impress people you don't like. And she quoted that back to me verbatim at our follow-up meeting. It made such an impact on her. And this book is kind of full of these kind of things. And there's one slightly longer quote. I'll quickly finish with this. Maury said, here's what I mean about building your own little subculture. I don't mean you disregard every rule of your community. I don't go around naked, for example. I don't run through red lights. The little things I can obey, but the big things, how we think, what we value, those you must choose yourself. You can't let anyone or any society determine those for you. Take my condition. The things I'm supposed to be embarrassed about now, not being able to walk, not being able to wipe my arse, waking up some mornings wanting to cry, there is nothing innately embarrassing or shaming about them. It's the same for women not being thin enough or men not being rich enough. It's just what our culture would have you believe. Don't believe it. So Tuesdays with Maury, really easy read, really well read, written. I would recommend that for anyone in this thing of ours. Who's next?
Is it an easy read, Nick? It sounds pretty heavy going.
No, it is, because he's really, the guy's funny. He's just joyful, and he turns. He knows he's dying, right? He knows it's coming down the track. I mean, we all know we're dying, but this guy knows I am dying in the next few months.
Wow.
But
it is. I read it a while ago. It is an easy read, and he's got that same author's got another couple of books of the same
You've
ilk.
been to Tenerife. Yeah. Alan Smith's been to Leavenworth. All right.
Mitch out. Okay.
I've just bought it on Audible, and Mitch Alburn narrates it as well, which is
I had the
author.
Kindle version, which I think was going for $1.99. So, but really good, really good, and it's actually quite uplifting. It sounds depressing. It's quite uplifting. It's probably more uplifting than Jonathan Haidt's latest opus. Right, who's next?
Me, I'm channeling my inner Wodge here. It's a high-performance podcast. I dabble in it. It's the notorious chef, Gordon Ramsay. It's brilliant, absolutely brilliant. Definitely watch it. He's in search of excellence, seeking excellence. Just amazing.
Thank you.
3 Michelin stars. Talks about his, history, his family, work in London. Just amazing, absolutely amazing, absolutely amazing. Check it out, Gordon Ramsay.
Great stuff. Thank you.
Carl?
No.
Go on.
The book that I'm going to recommend is one of the most profound books I've read in a very long time. It's called The
Ladybird.
Pardon?
The Ladybird Book of Colouring In. Go on, sorry.
It's called The Price of Tomorrow, and it's by a guy called Jeff Booth. It's quite a quick read. It's really, really impactful, and it will get you thinking. It is relevant to the work that we do. Jeff Booth is a Canadian entrepreneur. He's built and scaled multi-$100 million businesses, but he's really understood the kind of global economics situation. Just a headline I give to you, and I've obviously referred to inflation in the past before. Don't you think with technology as it exists is deflationary, isn't it? Does it cost more today to, let's say, get a pint of milk to the supermarket than it did 10 years ago or 100 years ago? It costs less. Almost everything should cost less because of technology, and yet we have inflation. Why do we have inflation in the world of modern technology? And his point being,
wages.
We're on the cusp of...
Cost of labour.
Sorry?
Cost of labour.
The cost of...
Wages.
But why though? Why?
Fiat money, the ability to print money?
Bottom line is fiat money and the ability to print unlimited amounts of money. Yeah, but he goes into it, he explains it in I would say layman's terms. And I think any of us, this is not an advert for Bitcoin or anything, but to get your head around this idea of runaway inflation compounding up forever in a world of that technology is only getting faster and faster. The changes of the next 10 years, you ain't seen nothing yet kind of thing. And I feel more informed. I've watched a couple of his YouTube videos ever since then. I recommend anyone working in financial services reads that book. It was excellent. That's it.
Okay,
Did you read it on Kindle, Alan, out of interest?
I did read it. No, sorry, I didn't. I bought it. My dad actually gave it to me when I was up visiting.
Physical
I've got
copy,
the hard copy physical version. Yeah.
I've just bought it on Audible for those of you who can't read like me.
Carl is busy keeping the Audible empire going. Interesting. I mean, this whole recent scare was caused by inflation, wasn't it? Because the Japanese inflation rate hit the highest for 40 years, so they were going to raise their base rate. Their highest rate for 40 years, 4%. 4%. We'd die for that as an average over here, wouldn't we? Okay, the final culture corner is from
The Chimp Paradox by Steve Peters, I think his name is.
Yep.
If you want to try and understand your own psychology a little bit better, this is a great read. I found some of it challenging, which might be good, might not, but it definitely got me thinking. Very, very deep stuff. The whole premise is that you've kind of got three brains going on at one time. You've got the computer, which is almost your autopilot. You've got the human, which is the logical, rational brain, and then you've got your chimp. So that's why it's called the chimp paradox. And the chimp is the emotional, one. And the chimp mind works much more quickly than the human mind. Anyway, I would recommend it. I really enjoyed the first 2/3 of it because I felt I learned lots, and I was challenged by the final third of it.
Yeah, I couldn't get through it. I couldn't get through it.
Yeah,
He's a very good speaker. He's a very. I don't know if you heard him speak, Carl. He's speaking at CISI, I think, in Manchester. He spoke last year.
So I heard. I would say, like, the book is again Audible for me, nearly 10 hours, and I think it would probably have been a little bit more impactful if it was 6 hours. I think there was a bit of repetition, but hey, I from the human mind, from if you're in our business, you're dealing with people, it's good from that point of view. I'm trying to, learn and grow myself, and I found it really good from that point
It's interesting.
of view. But tough. Some of it was tough.
Interesting you said that. I do find with a lot of these kind of books, I love them for the first two. I don't know if you guys find this.
Yeah.
And the last third or a quarter,
Same.
it's like, this is now getting really hard and could have been edited way better. And I just kind of...
Yeah.
So it goes from being a
They've usually
five-star
got
review to
one
a
or two good ideas.
Yeah, good point.
Yeah.
There's a lot of...
over and over and over again.
Morgan Housel says that most books should be a blog post, and most blog posts should be a tweet. Most they just expand more and more and say the same thing in 100 different ways.
Yeah, okay, it's not just me. Okay, cool.
Yeah.
Right,
what
brilliant.
was that book? There was a very short one. I can't remember, but the whole idea. I can't remember what it was, but it was like they were saying that this won't ever work because people won't value it as a book because it's way too short.
Oh, right. Yeah.
So it's a little bit like music, like you don't hear the 2.5-minute songs anymore like we used to because it needs to be a certain format because the human brain has been trained. This is giving me value or not. So maybe that's it. Anyway, I thought it was probably my number one book this year, even though I felt it challenging. But that's because it challenged me.
Yeah. Okay, interesting. Thank you, Carl. Okay, Trappists, Trap Pat. We are at just about 90 minutes. We're flagging. We're slowly melting away in the UK. Carl is slowly putting on extra layers in Limerick. But that's a wrap.
True story.
That's a wrap. It's amazing the difference in whether you just hop over the Irish thing. That's a wrap for this episode, dear Trappists. Thank you for your precious time and your input into this show. Please do like and subscribe to us on YouTube. We're not a million miles away from 900 SAPs now. Devoted viewers on YouTube. So please do click that little bell and do give 6 out of 5 star review on iTunes for the podcast itself, and make sure you subscribe on that, because then every other Thursday a fresh episode will just slide down into the pan and be on your phone, freshly cooked, freshly baked, whatever you want to call it. But until the next time, dear Trappists, that's a wrap. Take care out there, and we'll see you on the other side. Goodbye.
Goodbye.
See ya.
See you, everybody.
Bye-bye. All right.